You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call around here, the Options Insider Radio Network. Lots of great shows on the network, including well over 100 episodes of Volatility Views for your listening pleasure. Where can you check out all of that volatility goodness? Well, no shortage of places, including the website of record, theoptionsinsider.com. Surf on over there, click on the Insider Radio Network tab, and you're off to the races. Of course, while you're there, by all means, surf around, check out some of the education, the articles, the analysis, the unusual activity, the breaking news from the options market. Lots of cool stuff there for you to click around and enjoy. And then, of course, hit that Insider Radio Network tab, and you're off to the radio races, all 13 programs there. Of course, also iTunes, Stitcher, Aha Mobile, TuneIn, wherever you find your finer podcast programs, we are there, including via the App Store for our own mobile app in iTunes, Google Play, and indeed the Amazon App Store. No shortage of ways for you guys to check out the program and then let us know your comments, your questions, your feedback. Send them in. We love to hear from you. And joining me on the old program, once again, my volatility nemesis, the yin to my yang, the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
What I don't understand is, why am I your volatility nemesis if you allege that you like profitable trading? So if I'm your nemesis, you must love losing money.
You're just my nemesis in all things in life. That is your destination. That is your point of place on the network.
I gotcha.
Whenever you are on a show, you will be my show's nemesis.
So like I'm your Skellex to your whatever you were called from the Dark Crystal.
It's been a long time since maybe like Skeletor
no,
to my He-Man.
Remember like they were half and half, and like they like split apart where they were like the nice ones and the mean ones.
Vaguely. I remember that one scared the hell out of me when I was a kid, so I didn't really watch it.
Yeah, no, that was a creepy movie. I was like, oh, it popped up on Netflix. I was like, oh, let me see if my 5-year-old liked this. And I watched it for 10 minutes. I was like, holy gosh, I don't like this.
Evil, demented puppets are never the correct choice. That was Henson, I believe. They went in some dark roads in the latter days of the Henson stuff.
Yeah, no, I mean, there's definitely some, I think they learned their lesson and went a little lighter fare with Labyrinth. David Bowie never scared anybody.
Yeah, David Bowie, not too scary. But yeah, the Dark Crystal stuff. I'm sure they didn't do Secret of Nim. That was a cartoon. But that was, they did some crazy stuff. Dark Crystal, I remember, was pretty crazy. Crazy for its day.
Indeed.
There you go, listeners. That's your Muppet update. It's your puppet update for the week. And now, without further ado, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is indeed the portion of the program where we break down the week that was. From a volatility, trading, and analysis perspective, we are recording this on Friday, May 1st, for all of you playing the home game, probably listening to us on the following Monday or any time they're in. We know we welcome you guys weeks, months, even years down the road coming in after the fact. We love to hear from all you guys and, of course, have all you guys listen to us as well. And as we are recording this, of course, most of the major indices in a bit of a turnaround mode. We had to sell off yesterday. Today, it's rally ho mode, racing most of the gains, most of the losses of yesterday. Most of the major indices up about 1% or so on the day, and the VIX Cash taking it on the chin a bit, off a little, about 1.6 handles or so today to well south in here of the 13 handle at this point. So the weekend coming out, the sell-off coming out, not a lot of love for vol out there in them there hills today. So that's where we are today as we are recording this, but we go much farther afield than what we're seeing just today, listeners. So a lot of good stuff to dive into. Before we dive into that, let's start with the greasy meatball himself, Mr. Sebastian. In the week that was, including today, what has really caught your eye from a volatility perspective?
I think we talked about this on Option Block yesterday, is how kind of yesterday felt like a one-off. Andrew wrote, and I think you guys probably picked this up on the Option Insider blog. He wrote a spectacular piece on how phony baloney yesterday's sell-off was. And it was really just people selling gains in S&P because they were getting worked in currency and gold and a couple other things. And, so today's vol sell-off is just special. They brought vol in way more today than it had rallied the previous 2 days. VIX futures are just getting hammered. And, I just think maybe this is the final nail before we can finally get that 2120 level. We saw the Fed, not much come out of that. The only piece that's kind of interesting is that the move in the treasuries, where yields are, getting for at least in recent months, yields are getting up to a frothy 2.15% in the 10-year. So, that's a little surprising. I think that's probably a little overdone as well. If I was a betting man, I would buy the market and buy bonds at the same time, and probably short the U.S. dollar. So go long the U.S. dollar. So I would probably do those trades as a package.
That is indeed a frothy level, sir.
Yeah,
2% yield.
That was that. If you want to know what a short squeeze looks like, take a look at what happened to the Euro USD trade this week. It was just classic. A bunch of people got caught and were racing to cover. You're going to see that trade probably, it got up to I think 112, and you're going to see the euro move back toward, $1.07, $1.08. So or maybe $1.06. So, in a week for a currency trade to move, almost a dime is a huge move. And we saw something close to that. I think it was like 8 or 9 cents. So I'm expecting that to back off.
Yeah, there's probably been a theme of this year. It certainly has been oil and oil vol and all the things that are going on with oil, but probably secondarily to that, and probably not that much so in recent history, given what we've seen recently, has been kind of the resurgence of currency volatility. It's kind of been the story. We haven't really traditionally talked about currency vol that much in the long history of this program because there hasn't been that much to talk about. Really, currency vol is kind of dead in the water. That's one of the reasons that big Swiss franc ordeal was kind of the black swan of black swans. People had been just relying on the stability of that trade forever, on the pure lack of volatility in that space. And now post that debacle, or perhaps great event, depending on which side of that trade you were on. Now, of course, we're seeing a bit of a different landscape. We're seeing volatility coming back into these products. We're seeing a lot of independent movement of the different currencies. And that, of course, for us here on the program, selfishly, from a content perspective, but also from a trading perspective, it makes currencies a heck of a lot more attractive, and certainly something we can probably sink our teeth into a lot more here on the program going forward. Would you concur, Mr. Greasy Meatball?
Yeah, absolutely. I love it. And, there's tradable environments. one thing I had written about is that we've really, in the last year, seen three, somewhere not quite 2008, but worse than 2011 type events in major markets. We saw something in gold like that. We saw oil do something like that. And now we've seen kind of currencies in the middle of that. And so, it makes you wonder, at what point does it happen in bonds or in equities? So it's been pretty spectacular. I mean, I don't know what would be in between that, but we've definitely seen some really strong movement in major markets repeatedly over the last year and a half.
And if you're wondering, listeners, Mark isn't just getting worked up about the market, though he is that kind of guy. He's also on mobile, which is why he sounds a little out of breath. He is exerting himself as we speak here on the program.
Yeah, no, I'm walking into my house now, so we're good there.
So he's not just getting in a fever pitch over the market. Listen,
I am. It get a little of both.
Yes, perhaps a little bit of column A, a little bit of column B. Mostly column A, but a little bit of column B. While he transitions inside, we'll transition into our usual starting point here on the old volatility review, even though we don't mind our forays into currency. In fact, that's something perhaps people have written in about things like VSTOXX and others, maybe adding that to the fray, and we got something to add for that this week, but perhaps even adding perhaps a regular check-in on the currencies going forward. So if you're interested in that, let us know as we dive on into our usual starting point. That is the land of equity index volatility, in particular, ye old fear gauge. And it was another relatively, comparatively modest week. I mean, a little bit stronger than other recent weeks, but still a relatively modest week from an overall volume of a VIX options perspective. Decent range, actually, in the VIX Cash itself over the past week, with a low of about 12.3 up to about a high of about 15.3, so about a 3-point range or so out there. So a little bit of swing out there in VIX Cash land, and we're coming back down the other side of that, of course, as I mentioned earlier today. So a bit of intra-week range, and yet none of that really translating into too much, at least from an overall volume perspective out there in VIX options land. We saw beginning of the week, it seemed like the trend, and perhaps not surprisingly, as volatility was tracing up a bit earlier this week, the trend earlier in the week seemed like it was all on the upside, with all the love coming on some near-term calls, in particular May 20s. We saw a big buyer of those coming in earlier this week. I believe it was on Wednesday, picking up about 75,000 of those, about 40 cents. We also saw some put buyers, the June 13 puts going up. I don't have the exact amount, but decent size for about 15 cents. Earlier this week, we saw some May, June, let's take some time spreads going up as well. It's like rolling out to June on the 13.5 puts as well. So some time put spreads, but for decent size, about 10,000 contracts. And again, in this relatively light environment, that's pretty sizable paper. And also looks like a bit of a risk reversal financed by some puts, or just a call spread financed by some puts, to the tune of the June 17-20 call spread versus the 14.5 puts, going up somewhere in the neighborhood of about 30,000 times. So pretty decent paper. People still liking their June upside for whatever reason. This time turned into some puts to finance it, but still some love here for a June upside. Before we get into the overall numbers, Mark, any action out there in VIX options land that really caught your eye this week?
Nothing in particular. We saw a lot of there's some pretty decent activity at the May 20 strike and the June 20 strike. But aside from that, I didn't see any kind of ridiculously screwy trades. It was just more your standard, hey, we're going to buy this or we're going to buy that. Nothing really popped at me, if you will.
Yeah, there wasn't a clear narrative this week. Paper was kind of all over the board. They were buying May upside, they were buying June upside, financing with puts, buying June puts. It was kind of all over the place, rolling puts. So another one of those weeks where no clear narrative, unlike, a few weeks back when that guy was just buying all of the June upside he could possibly get, and then some. We didn't see anything that dramatic. Of course, the May upside was pretty substantial, probably the most substantial thing we saw going up this week in terms of where people were fixating their interest. Not surprisingly, the June upside still leading the charge with all this renewed love for upside in June. Continuing again this week with that call spread. The June 23s leading the charge, about 400,000 contracts open. The leading strike by far, drop off about 50,000 to get to the May 20s for the number 2 spot, and then you go all the way down off a cliff to the number 3 spot with the May 21s, only 237,000 contracts open, so about 160,000 contracts or so change between the number 1 and number 3 spot. It shows how much action there's been on that June upside in particular the June 23s and the June 17s, a little more reasonable strike with about 226 open. Then you go down to the May 16s for about 180,000 contracts, and then the May 14 puts for 170,000. Then it pretty much drops off from there again, getting down to the June 14 puts, the June 20 calls, and the May for about 160 or so thousand contracts open, and then the May 12 half puts and the May 23 calls, bringing up the 9 to 10 spots with about 135 and 130,000 contracts open, respectively. Total on the day here, and total so far, at least for the month here, about 6.14 million contracts open, 4.4 on the calls, 1.75 million on the puts. It's actually fairly robust open interest, given the fact that overall volume has been somewhat light, been much reported on, widely written about the fact that VIX volume is off. In fact, we talked about it on the option block yesterday again, and a big report coming out of Tab Group yesterday, Mark, that they kind of breaking down the numbers. This is for Q1, so going through March obviously doesn't include April, but still one of the names that was leading their volume declines for Q1 was, of course, VIX, leading the charge to the downside. Not a place you want to be in from a reward from an award perspective. They were off 45%. In Q1, that's a pretty impressive slump that even beats Facebook's options volume, which decreased by 35%. So overall, it hasn't. Traditionally, these are decent times to be in the VIX business. So far, at least the beginning of 2015. Not so much. What do you think, Mr. Sebastian? You think this is kind of just a bit of a cyclical thing? You and I have kind of pontificated about this a little bit, off the air and on the air. You think it's something we're going to see continue? I mean, traditionally, this is the time of year where we start seeing this. Getting into May, you start seeing the vol fall off a cliff. You don't see it through March into April. That's kind of scary.
Yeah, I feel like with what the Federal Reserve is doing, kind of holding the market hostage, that can really be having an effect on things. I don't think it's a permanent thing, but I think it does point toward, until there's, the Fed either rips off the Band-Aid or announces that they're leaving the ace bandage on forever. The market's going to be in kind of an odd spot. Yeah, I mean, I've been surprised by how much it's fallen off, but I do think that you may see that continue. What's interesting is I don't think we've seen the same decrease in VIX futures. So that tells me there's still a market there. This may just be an option thing.
VIX futures are off as well, but you're right. I think the numbers are substantially less than it is on the option side. I'll have to dig into that to make sure, but I do believe you're correct. It's certainly a decrease, but nowhere near the 45% or so we saw out there in VIX options.
That's what I'm saying. Is I think that. It'd be one thing if we saw the futures decrease by 45%, but I think they're off, marginally, nothing huge. They haven't had, the only reason why they're really off is they haven't had a couple of those days where they have those huge, 300,000 days where the market's off, massively. But I think if you looked at kind of a normal day to a normal day, there's not a big change in volume.
Yeah, I'm looking here at some other analysis of the numbers, and they mention overall drop, and they mention the close to 50% drop in VIX options. So, yeah, it is the options that is leading the charge over the futures. To the downside, for whatever reason, the options player is not coming out in droves in VIX land. Maybe one of the reasons why perhaps this is something that our listener was keen to, and they wrote in a few weeks ago. Someone wrote in, you may remember, Mark, asking why we don't touch on VSTOXX that much. And quite frankly, like we said, there hasn't been that much to talk about. Maybe that tune is starting to change. I actually came across an interesting article. I don't see many articles even analyzing VSTOXX and maybe comparing and contrasting it to VIX. And our friends over there at Futures Mag reprinted a very interesting one called Volatility Cycles and Stock Trends. If you're into the whole VSTOXX thing and maybe comparing and contrasting how it performs to VIX in certain scenarios, I encourage you to check it out. It's a pretty interesting read. Got a lot of great graphs to get into. It has a number of great points. Again, I encourage you to read the whole thing if you want to check it out for yourself. There, listeners over there on Futures Mag, or to search for Volatility Cycles and Stock Trends. But it comes with a number of interesting points I want to mention to you, Mark. First off, it kind of started off on an interesting note, and I kind of highlighted this because seemed like it was kind of a foregone conclusion a while ago. Maybe I think the narrative has kind of shifted on this. The article starts off talking about kind of the history of VIX, as you might imagine, how they changed it from back when it was OEX to S&P 500, and they changed it again. And they said when they changed it again to include the skew, they created a more robust calculation based on the moneyness weighted smile of S&P 500 options. I think that was the initial narrative. People liked that addition of the skew, but maybe in the last few years, some of that has maybe shifted a little bit. Some of that narrative, people thinking, obviously there's all the accusations of things being manipulated by using the out-of-the-money puts around settlement time. Of course, there's all people out there like Scott Nations clearly think there's a market for ripping the skew out of VIX and just making straight up applied of the S&P 500 again. So I'm curious to you, before we even get into the article itself, do you think the new version with the moneyness and the skew is a better iteration than the not old, but maybe second iteration of VIX?
Yeah, I mean, I don't think that you can really talk about volatility without talking about the curve. Skew is so important and is such a big piece. Like if you look at, I hate to keep bringing up Buzz Gregory, but his stuff, I mean, skew is such an important piece of the volatility curve. To ignore it is, I think silly. Now, would I maybe restructure it so it's a little less weighted? Is there maybe a smarter way to do it? Probably. But I think throwing it out is ludicrous.
Yeah, I kind of leaned that way to begin with, and then I was surprised at kind of the preponderance of industry energy and inertia seemed kind of pulling it the other way. Like I said, so much so people are trying to launch products to do just that. I always kind of thought that the skew had some value, and leaving that out of the equation kind of meant VIX was missing some of the picture. So I kind of lean with you on that sense. I think it does make some. I think you're right. They could do some things to perhaps avoid the carpet bombing we see around settlements.
And let's not forget what VIX is really based on, and that's variance swaps. And variance swaps absolutely have moneyness and skew in them. And you can't, if you want to create a product that has that upstairs desks can use to lay off risk, you can't ignore the kurtosis and skew. It's just silliness. So, that's why none of these other little products work. Is that at the money vol's great and vol is fine, but it's not. You can't just throw out what all the upstairs desks are trading.
Speaking of variance swaps, is one of the interesting points they do make in this article, kind of comparing VSTOXX to VIX and how they perform. They mention the VSTOXX, the way that formula works out, it kind of settles into what they effectively refer to as a fixed leg of a variance swap, which is kind of correct if you look at it. And by looking at it that way, you can see that a pronounced sell-off in the market actually really dramatically elevates the spot VIX, more so than the first month of the futures and so on out the curve. So there's some interesting impacts there. We kind of see something a little bit similar with VIX sometimes when the near end of the curve gets insane and some crazy developments in the marketplace, whereas the longer portion of the curve kind of has a little bit more sensibility, shall we say, to it and doesn't get as dramatically impacted. So they lay out some of that with some cool graphs in the article as well here. Again, I encourage you to check it out just for no other reason than for the fact that it's some analysis on VSTOXX and how it compares and contrasts to VIX in some interesting ways, of course, to the downside volatility increases, kind of as you might expect, and a lot of other scenarios, and how VSTOXX purports to perform, and also how you can use it to show that option buyers in general are more prone to pay up for historic volatility during the very, very early phase of an aggressive sell-off in the marketplace, which has kind of been always the conventional wisdom. People are seeing the panic. They're fleeing for the exits. They're diving in as soon as the bad news is breaking, and they're paying through the nose to get that protection versus the latter stages of the sell-off. People kind of know what they're in for at that point. They're not really perhaps panicking as aggressively. All some interesting detail for that. It's nice to see, Mark, a breakdown of VSTOXX, just because we see it so infrequently, and maybe it's perhaps maybe that's starting to change as people are maybe, as we see with the volume numbers, maybe starting to tire of VIX a bit.
Yeah, I mean, maybe. The one piece that maybe could, and this might be the piece that's really killing VIX, is that they talked about the fact that everybody uses S&P 500 skew to everybody uses S&P 500 to hedge. So that skew is already so overpriced that it may be what's muting VIX and really causing problems for the index. Everybody in the world using S&P to hedge is going to invariably cause VIX to become a less effective measure, and that could be part of the issue. VSTOXX does not have that same amount of problems, so there is something to it.
That's true. They finish off the article here about VSTOXX. They say the VSTOXX thus acts not only as a volatility index and a trading vehicle, but as a psychological barometer as well. It tracks investors' collective senses of rising fear, climaxing as sell-offs end, and of complacency as bull markets signal happy days, and not only here again, but also intend to stay forever. The writer prone to a bit of hyperbole. But he writes, in short, this is a market that works. So he at least making the argument for VSTOXX, perhaps, over VIX. Interesting stuff. As we're talking, fixating about international vol, let's look really quick to one of the other few places in the world where VIX has gained any sort of foothold. That is indeed in India. We had a listener write in recently with some questions about India metrics, where to get good data on India. We had some decent ideas for him. I sent him some more since then. But of course, some of the metrics come out of India that are reliable come on the VIX side of the fence, where we see VIX, again, the India VIX off the Nifty, one of the few places that's gotten any traction, generates any regular volume. We've seen a decent sell-off in the Nifty just in the past month, nearly 4% in April. So second monthly sell-off in consecutive. So not a good period to be long. The Nifty, as you might expect, that's been juicing up the India VIX over there quite a bit, and volume doing a pretty significant turnover over there as well. So VIX not doing so great domestically here, perhaps, but that not exactly being the story overseas, as our friends in India perhaps not happy that the index is selling off, the broad index, of course. But if you're a volatility holder or a VIX owner out there, perhaps a little bit happier. Mark, do you watch the India VIX at all, or is that kind of just more in the international volatility noise for you?
Yeah, it's just I think that's international volatility noise. It's active, I know, but that is certainly not a major piece that I'm following along with.
Yeah, it's one of those ones where it's kind of the only other game in town. You got VSTOXX and you got India VIX, and it's kind of about it. So when you talk an international vol from the pure volatility instruments perspective, it's kind of not much else. That's why we always try to find whatever's going on out there whenever possible. And this week, actually, something to dig up, which is of interest to all of our listeners who are always writing in saying, hey, talk more about international vol. Talk more about international vol. There you go. VSTOXX and India VIX getting a lot of love on the show this week. But as we move on to a product category that I know a lot of you are really interested in this week, or not just this week, but this month, this year, last year, that's crude, everything Texas tea, everything black tar, just lighten it up, of course. The bulls still in pretty much control out there, but perhaps getting a little bit tempered by some other developments out there, the push-pull of production cuts versus other developments versus demand weakness versus everything else really starting to play out again out there. Some people talking about, resistance levels in WTI, if they're coming to place, if 60 is the next resistance, et cetera, et cetera. A lot of discussion there, kind of like the same way we had it to the downside. Now we're having that same conversation in reverse to the upside. Of course, not surprisingly, with this protracted upside move, we've seen vol pretty much coming off across the board. Most of the products, including the USO, the ETF, which is hovering about a 36, and the OIV, which is, of course, the big crude oil options vol, hovering at about a 37. So well off the levels into the mid-50s, into the 60s that they were getting in the teeth and the height of the sell-off there. And speaking of oil vol, Mark, I was looking at some interesting analysis out there in the oil volatility landscape. This might have actually come from Futures Mag as well. So they're on a twofer for the show today. I need to give them their points when it's due. They had an interesting write-up about how essentially all of this rally out there in crude land is, of course, reducing volatility, as we just mentioned, which, of course, as our listeners know, reduces the premium for the options that they would in turn come out to hedge with. So it's increasing incentive for a lot of the producers out there to come in and hedge themselves at these levels, makes it a lot cheaper for them to do so, which in turn can reduce the impact of further shocks coming out of OPEC or other moves that may take to move oil back to the downside again. So in effect, kind of arguing that the reduction we've seen, the dramatic reduction we've seen out there in crude volatility may indeed insulate the market against further dramatic moves to the downside. What do you think, Mr. Sebastian? Is that you buy that argument, or is that more kind of macro, crude, tinfoil hat kind of stuff?
Yeah, that's a little chicken and eggy kind of stuff. I mean, because it's cheaper to hedge, people will hedge, and that'll soften things up. I don't know that that's true because the oil VIX is coming from about 11 or something like that, and that didn't seem to make people want to hedge, did it? So what I think we're really seeing is just more supply and demand, macroeconomics, but the idea that a decrease in volatility in the options is what's causing the underlying to actually reduce in volatility is. I've never heard a real valid argument that decreasing implied volatility yields decreasing realized volatility. I mean, if you can find me a study that proves that, I would be fascinated. The only thing that you might say is maybe implied volatility starts to decrease ahead of realized, but in this case, no. I mean, we saw implied stay above 40 for a long time while oil vol had at that point fallen into the low 30s, high 20s. So I am not I think the reason why implied volatility is cheaper and why everything is cheaper is that realized volatility has fallen off, and the underlying people don't think the underlying is going to 30. Citigroup, sorry, you're wrong.
Yeah, maybe the days of crude to 30 have been tempered somewhat. That call a little bit less.
I hope that the funny part is the person that made that call is going to get some sort of bonus.
That guy got a promotion because he got so much ink off that's all their job is. Their job is to get ink.
That guy should be fired for that call. I mean, honestly, you make a call that ridiculous and that bad, and you're going to get promoted. Great work.
I was talking to a guy who runs a bunch of analysts, and this is just between you and me and the listeners recently, and he was saying, his job, he tells his analyst, is to write things that are quotable. So not even so much to be accurate or provide meaningful analysis, just to be quotable, be out there, get published, get picked up and inked and be quoted, because that in turns, traces back to the firm, the mothership, and gives them all sorts of other value. Yeah, well, so that guy certainly did that.
Yeah. Well, it makes Citigroup look brilliant, right? I just, so they're calling. Where did their case went from what? Oil's going to 150 to oil's going to 30 or something ridiculous like that. That guy is just, I mean, anybody who's listening to him, there is an analyst out there who is just consistently wrong, and everyone trades against her. And maybe that's what this guy's trying to become. He's trying to become the market VIX. So in terms of correlation.
Well, we've seen this in market for this. Look at all the guys out there who make ridiculous prognostications about Apple every quarter, and what they're going to come out with next year. Things that are pie in the sky nonsense, but they know they'll get quoted on it, and they'll get ink on it, and then next quarter it's another ridiculous thing, and it goes on from there. So that's the problem. Maybe faulted with the media to a large degree. That's why we don't bring a lot of analysts on these shows, because we know that most of what they say is kind of useless, and so we don't do that a lot. But a lot of the other media, they like quotable things, and so they go with that. And unfortunately, that's the world we're living in, or perhaps not so much the world where decreasing oil vol is going to lead to reduced downside risk in the near future. It might be interesting. I wouldn't mind seeing that world play out. I just don't know. I don't know if that is indeed going to be the case in the near term. If airlines can't be persuaded to hedge their one fundamental risk, which is crude, on a more ongoing basis, I can't imagine a lot of the other players in the space will be incentivized to do more so, even if options are cheap out there, and they certainly are cheaper now than they were a few months ago. All right, and with that, I want to make sure you guys get some time on the old program as well, so without further ado, we're going to check in on the old volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, like the man said, this is the portion of the show where you guys get to chime in, let your questions and comments be known, not just to us, but all of your fellow listeners as well. Got a lot of great questions and comments Coming in from you guys, I think we'll kick things off here with a question from Eli. He writes, would you agree that VXX shares are a useful intraday way to trade volatility? What is the longest you would consider holding, I think he meant the underlying, you missed a word here, before the roll yield effect begins to kick in? Well, good question here, Eli. We have maligned VXX many times on this program. I think Jared's the only one who comes to his defense on a regular basis, and he isn't here, unfortunately, for you, Jared, or Eli, so he won't be coming to the VXS's defense today. But I think we've all said in the past that for a short-term tool like what you're outlining, VXX is perfectly suitable for that. If you want to have some intraday view on volatility and you think it can be captured in that very, very short span in VXX, and it's one of the better use cases I've seen versus trying to hold it for 6 months. That certainly would be a disastrous way to use that product. So very, very short term. The other side of your question, I think, is more interesting, which is what is the longest you would consider holding before the roll yield effect? That's a good question. I'm not comfortable holding it more than really a trading session, maybe 2 at the most. I don't know, Mark, would you go much beyond a couple of days with VXX in your account if you were like a buy and hold retail guy?
I probably wouldn't hold in a weekend. I think really it's how is your trade worked out. So, if you buy some VXX and intraday volatility increases and you perceive it to continue to do so, then yeah, it's absolutely worth holding up. If the VIX futures are rallying, VXX is not going to lose money. All right, it just is not. But the key is that what's the duration of your trade, and so if the duration of your trade is a 2 or 3 day, that's probably fine. But, once you get to that third day of volatility increasing, that's probably the time to really evaluate whether it's worth holding on. So your trade works, and then it works another day. That third day, if it's still working, time to start taking some money off the table. Roll yield is an interesting thing. It absolutely does kind of exist, but only in the sense that, when the VIX futures curve is kind of sliding down. If futures are steady or rising, you're not gonna really, you don't actually face the roll yield in the way that most people expect to, if that makes sense. So it is not as cut as dry as if I hold it, I will lose this. It's more the concept of the futures sliding down the curve over time. And so as long as those futures aren't sliding, you will be, the trade will work. But, the futures are going to start sliding as soon as there's any hint that volatility relaxes.
Yeah, obviously a lot of other factors playing in there, like I said, the term structure and everything else and how they're performing. But you're right, the intraday nature of that trade kind of gives you a nice barometer for it. If you're planning to trade intraday, then you have that nice time horizon. If it's not working out for you at the end of the day, then probably take it off. If it's not working out, maybe you have another shorter time horizon. You want to go another day, maybe. But yeah, beyond that, you're starting to get a little bit crazy, and certainly you're testing the use case, the legitimate use case anyway, of a product like VXX. I can hear Jared chiming in from somewhere. I'm sure his ears are burning, saying time value of money is a legitimate thing and all those things. So I should probably just mention those as well, because he is correct. But still, it is also a frustrating thing for people who are trying to use this product in a way that it was perhaps not intended to, but has been appropriated by so many of the retail masses and indeed the trading masses out there. So an interesting question. Good one, Mr. Eli. Check out the VIX term structure if you're going to be trading these products as well, so you can see exactly what you're up against when you're going in, how much of a bite that's really going to take off me. Right now, this actually is not a bad time really to be thinking of a trade like that, because it's not as pronounced as it has been, of course, in recent years. Again, a issue that SIBO has been pointing to repeatedly as an excuse for some of its paltry numbers out there in the VIX complex. Moving on to a question, since we're talking VIX-related stuff, we have a question here from listener goes by the handle Oaklander. He or she writes, do VIX options suffer the same from time decay as regular options? Are there one more time, easy for me to say. Are there peculiarities to the VIX formula that make the options perform differently on a theta basis? Mark, this is a question we get a lot around here. There's this, belief that VIX options are an entirely fundamentally different beast, because they are, in pretty much many senses of the word, a derivative of a derivative. They're kind of created out of whole cloth by this other formula. So as a result, they're not at all the same beast as a regular equity or index option. They don't have the same kind of Vega rules. They don't have the same. And you and I have argued about VIX skew, whether it should exist before. We'll leave that out of this conversation for now. We'll talk about more of the fundamentals like VIX theta and stuff like that. But yeah, there is this kind of widely held belief that these products don't have these things like gamma, don't have these things like delta, and as our listener points out, maybe even don't suffer from theta as well, the way a lot of traditional options would. What do you say if someone comes into Option Pit with a question like Mr. or Mrs. Oaklander? What would you say to them?
I would say that the issue is that the big difference is, one, they're priced off of futures, right? So that's the first thing you got to look at, right? But they settle in this cash. So what I would say is that, puts and calls act very differently depending on the shape of the curve. So, sometimes, in a normal curve where the VIX futures are in contango, calls almost have a secondary theta, where you've got the theta decay from the insurance premium of the option, and then you've got the decay of the future conversion to cash. Whereas puts have it the opposite way, where they may actually have a theta to them, but there's this underlying futures decay that actually causes puts to rise in value over time. And so that's really what I think is different about VIX options more than anything. It's you've got the fundamentals of the options themselves that are the same, but then you've got this decay in the actual underlying that is really what changes everything.
Maybe it's time for us to reinvigorate our debate of whether a VIX skew should exist one of these days on the show. We haven't jumped into that one.
Well, quite some time. Should it exist? I mean, really, S&P skew shouldn't exist if you ask, professors. But it's all supply and demand stuff. So if supply and demand is a certain way, then that's the way things are going to be.
That is true. That is the practical, ruthless pragmatism of the marketplace at work. Hence, skew existing pretty much anywhere is all ruthless pragmatism at the end of the day. I should have jumped to this one next. This trails off of the VXX question. We'll jump into it now instead. This one comes from Charlie B. He writes, long VXX versus short out-of-the-money front month of VIX call. I like this. Can this be considered a covered call? What other sorts of volatility yield strategies can you recommend? Well, Mr. Charlie B., if you can find a broker who will consider VXX shares in delivery for a short VIX call position, let me know. I want to know about that broker and maybe perhaps speak to them a little bit. I don't think you're going to be able to find someone who is going to consider those to be mutually offsetting positions in any way, shape, or form. Nice try, though. I give you bonus points for expanding our horizons a little bit. In terms of the other part, well, Mark, I'm sure you concur about the first part, so I won't dodge on that one. I'll give you a chance to chime in on the second part. We talked a lot about volatility yield strategies, all kinds of different stuff, all different ways on this show, whether it's, the traditional kind of harvesting of delta neutral, making a lot of different adjustments, or trading some of the different indices against each other, or trying to carve out other ways like that. But I don't know if they really would be called yield so much. What would you think of in, that would be, I guess, what our friend here, Mr. Charlie B., would think of as more of a volatility income type strategy that is different than buying VXX and writing a VIX call against it. Even though I like that.
I would not do that. But there's short XIV, short VXX at the same time. I would actually rather probably do some sort of, you could do some sort of in the money call spread, where you're long kind of the cash part of VIX, and you could, maybe selling at the money calls in VIX and buying an in the money call in VIX would be a way to kind of creating income and having some sort of long exposure. But I don't see anything that was really special about either of them. That would be buying futures, selling calls. the one thing we kind of like to do is really the simplest would be to sell puts and VIX. That would probably be the best way to do it, as I think about it. And you don't get tons of premium, but there's a pretty decent return profile selling the 13 or the 13.5 put in VIX, something along those lines.
Yeah, that's kind of the issue I kind of had when I first saw this question as I was reading it today. Is that none of the answers I would think of to him are going to be that sexy. It's kind of like what you just said. It's like the futures and the VIX, or even you're right, a put. Those both work, and they are very much vol yield in that sense. But they're not, not going to be a sexy thing that he probably wants. He wants some crazy, reverse swap ratio thing that isn't going to please him. But still, at the end of the day, that's kind of what it is, unfortunately. All right, that's why I love the listeners of this show, though, is that they come up with some great stuff. I do want to commend him for trying to pass that off as a covered call. He gets bonus points for that. I like that. All right, good questions here. We got more from you guys, of course, but we got to keep rolling with the show. You guys know how to hit us up if you have questions. We read them all, even if we don't get a chance to answer them all on the air, and we try to respond to you guys. So send them in Facebook, Twitter, email, all that fun stuff. You know how to find us, or of course, just go to the website. It's all baked in there. And now it's time for us to roll on into our final segment. It's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, Mr. Sebastian, we've been talking a lot about what's going on here in the current volatility environment. Now it's time to look ahead to what's to come. Of course, we have some interesting developments on the horizon from a vol perspective. We've talked a lot on this program in recent months about how non-farms haven't really been that big of a driver of late. You used to see, certainly back in the day, they were big premium buying drivers. People would come in to hedge against non-farms. They certainly would be reticent to sell. So you'd usually see a general increase in volatility going into those events. Of late, certainly over the better part of the last year, that hasn't been the case. People have actually been selling vol into non-farms, which was kind of a bit of a turn. Now we have a non-farms coming up next week. Of course, our last big announcement kind of shook the market, caused some pronounced vol back in the marketplace, maybe burned a lot of those people who had been selling vol going into that. So I guess my question for you is, what's your outlook for next week? And also, what do you think going into our first big non-farm since the big event of last time? What do you think we're going to see? You think we're going to see more of that kind of old school non-farms coming back where it actually matters again from a vol perspective, or was that last time kind of a one-off aberration?
No, I think you're going to absolutely see that. I think what we might see is the VIX, without really the market selling off or anything, creeping back toward maybe the upper 13s. Maybe it touches 14 again. And then you'll see a bunch of people step in on Thursday and bring it back down to 13.5, and then we'll see what happens on Friday morning. That'd be kind of my guess. So do I think the VIX will be higher than it is today? Yes. Do I think it'll be markedly higher? Maybe somewhere near 14 is about the best I could see it moving.
So you don't see non-farms setting us rocking and rolling again this time? Unfortunately,
no. So I do not. But maybe out of non-farms, but probably not into them. What'll happen is you get these people that run up vol, and on Thursday morning, everyone's going to go, well, why would I wait till tomorrow when I can sell 14.25 volatility? And then they'll come in and sell it.
We certainly have seen no reticence to do that.
Pattern.
No reticence to do that of late. Well, of course, next week I'll be coming to us from the big options industry conference in Miami, so I'm looking forward to see what interesting volatility nuggets I can dig up while I'm down there. Of course, I get a lot of great time to meet with all the various heads of the trading firms and the brokerage firms and the exchanges and whatnot, and get some interesting insight into what's cooking on that side of the fence. So hopefully we'll have some fun stuff to share with you guys on the program next week. But before we go, as always, let me check in with my cohort here, my volatility nemesis, my partner in crime, if you will, to see what he has cooking that may interest you until the next time we can all gather here together around the old Volatility Views panel. Mr. Sebastian, what's cooking in the land o' the pit?
Just read the blog. Andrew just wrote a really awesome one about, skew and this, like I talked about, worth a read. I've started doing a kind of my simple trade of the week that I'm doing. So that might be worth a read as well. And, just check things out. And, Mark, I know you're going to be in Florida. I pulled a pretty sweet guest when I was in RMC. I'm expecting you to find someone really interesting to bring on the show next week.
I will do my darndest. I have a lot of guests throughout the week. Whether I can wrangle one for that exact time frame on Friday, we'll see. We'll see if I can work.
Otherwise, you're going to have
magic.
to basically admit that I'm more awesome than you.
That will never happen, sir. Since you are indeed my volatility nemesis and nemesis in all things in life. All right, thank you for that, Mr. Greasy Meatball. And on behalf of Mark and Jared, who couldn't join us today, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Keep them coming. We love to hear from you guys. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.